Let's just talk about Target for a minute. Is Home Depot, is that a possible read-through to what you expect from Target? One thing they have in common, the large majority of their sales are discretionary. When you look at Target, only 21% is grocery compared to Walmart, which is more than 50%. Are you worried, or should investors be worried that what we're seeing in Home Depot is going to bleed through to Target?
Yeah, well, there were three things I think that impacted Home Depot, and some of those certainly are a read-through to Target. It was weather, it was housing weakness, but then also it was weaker consumer demand in general, and I do think that will impact Target. We saw that with the retail sales numbers that came out yesterday that were up sequentially, but are actually decelerating pretty sharply on a year-over-year basis. And of course, that's what retailers look at when they're talking about their same-store sales. That's a year-over-year measure. So we do expect a little bit of a soft number from Target. Now, the good news, I suppose, is that we think that is largely in the estimates. To your point, they guided pretty conservatively for the year, and the estimates are pretty conservative for the first quarter. Let's also remember, and I think this is important, as bad as Home Depot's report was yesterday, the stock was down maybe 1%. The market seemed to already anticipate it quite a bit.
All right, fair enough. So give us a sense of what you're thinking about when it comes to Target. What's your rating and what's your price target?
Well, so we have a buy rating on it. It's a $200 price target. The reason is it's really about cycling what can only be described as a debacle last year. Their margins got killed because they were really the poster child of that over-inventory position. That is now behind us. Their margins were in the 3% range. In the dozen years prior to the pandemic, they were never lower than 5.5%. They averaged 6.8%. They ranged from 5.5 to somewhere in the 8% range. Last year, they were 3% because of all the markdowns that they had to take. Our view is that they will climb back to that pre-pandemic range, somewhere in the 5 to 6% range, as you said, over the next 24 months. But they're going to climb towards that area this year, above 3.3%, which is where they were last year. And so when you do the math, they're going to end up having the highest profit growth of any of the big box retailers that we cover. Granted, off of a low base, but nonetheless, their profit is going to grow this year.
Very interesting. So just by the way, for the viewers, your price target has about a 25% upside from where Target's trading right now. So we're also going to show the viewers the different segments of Target's business. It's beauty and household, 27%, grocery, 21%, home furnishings, 18%, electronics and toys, about 16%. Potentially, where would the weakness be and where would the strength be?
Yeah, the strength is going to be certainly in grocery. Also, beauty and household. Their beauty business has actually been really strong. We've seen that across the board for beauty retailers and beauty companies. Estee Lauder, of course, missed, but that was overseas. Domestically, their business was very strong. Target's partnership with Ulta is working really well, so that's going to be an area of strength. The weak area is going to be home furnishings. Again, some of the retail sales numbers that came out yesterday, the home furnishings sector was really weak, and we expect to hear that from Target as well. And toys hasn't been a great area. Now, it's not really the toy time right now. We have till December to work that out, but that will be an area that won't be as strong, we think.
All right, so is that a bellwether for the broader retail sector? Should we take what we hear from Target today and use that to read through to other earnings like a TJX and a Walmart coming up?
They're $100 billion retailers, so certainly they matter. There are 4 or 5 that we think are the bellwethers: Target, Walmart, Home Depot, Costco, and we think that they all matter. We think the overall theme is going to be slowing retail sales at the beginning of this year, and then probably bleeding into the back half of the year. Our estimates for the full year are for same-store sales to grow at the smallest rate since 2008, the Great Recession. So I would consider them a bellwether, and I think what we're going to see is a slower consumer. But we also think margins are recovering. Supply chain costs are not as big of a headwind as they were a year ago. And the big story to me this year is going to be that inventory glut and overhang that we really wrestled with in 2022 is now largely behind us. And so a lot of retailers are cycling the massive markdowns that they took a year ago, and that shouldn't repeat in 2023.